Welcome to UK Property Info. Something extraordinary happened to the UK property market over the past 2 years, and unless you understand exactly what occurred and how quickly it unfolded, you will struggle to make sense of where we are now and what comes next. This is the story of the fastest buyer retreat in modern British housing history. A pullback so sudden and so complete that it transformed a frenzied market into a frozen one in a matter of months. If you find this analysis valuable, I would genuinely appreciate you subscribing to this channel. We are a small but growing community, trying to cut through the noise and provide honest property analysis that actually helps people make better decisions. That simple action costs you nothing, but helps this channel reach more people who need to understand what is really happening. Now let me walk you through exactly what happened so fast that UK buyers pulled back. To understand the speed of the pullback, you need to remember what the market looked like at the start of 2022. The UK property market was experiencing conditions that many described as the most frenzied in living memory. Properties were selling within days of listing. Sealed bid processes were common, with buyers offering 10, 20, even 30% above asking price. Estate agents reported receiving 50 or more inquiries on single properties within hours of them going live. Mortgage approvals were running at record levels. First-time buyers were stretching to absolute maximum borrowing limits. The average time from listing to completion had compressed to historically short periods. This was a market operating at maximum velocity with maximum confidence. Buyers were terrified of missing out. The prevailing wisdom was that prices only ever went up, and that waiting to buy was the worst possible financial decision. By the end of that same year, the market had transformed completely. Buyer inquiries had collapsed by over 28%. Mortgage approvals had fallen by more than 35%. Properties that would have sold in days were sitting for months without offers. Price reductions became the norm rather than the exception. Chains were collapsing at rates not seen since 2008. The frenzied buyers had simply vanished. What happened in between those 2 points is a story of compound shocks hitting with unprecedented speed. The first and most important shock was the interest rate reversal. For nearly 15 years, UK buyers had operated in an environment of falling or stable ultra-low interest rates. The Bank of England base rate had been below 1% for over a decade. For most of that period, it sat at historic lows of 0.5% or even lower. An entire generation of property buyers had never experienced a rising rate environment. Their mental models of affordability were built entirely on cheap money assumptions. Then in December 2021, the Bank of England raised rates for the first time in years. That initial move from 0.1% to 0.25% seemed almost trivial. Many dismissed it as a minor adjustment. But it was the first domino in a cascade that would fundamentally reshape the market. By February 2022, rates had risen again, by March again, by May again, by June again. Each successive rise came faster than markets had anticipated. By the end of 2022, the base rate had climbed from 0.1% to 3.5%. By summer 2023, it had reached 5% and above. 14 consecutive interest rate rises in the space of 20 months. Nothing in modern British monetary history compared to this pace of tightening. The impact on mortgage affordability was immediate and devastating. Consider a buyer who in January 2022 could afford a £300,000 mortgage at a rate of 2%. Their monthly payment would have been around £1,270. By autumn 2022, that same mortgage at 5% required monthly payments of over £1,600. That is an increase of more than £330 per month, or nearly £4,000 per year. But here is the crucial point. Mortgage affordability calculations work on multiples and ratios. When rates rise, lenders do not simply charge you more for the same loan. They approve you for a smaller loan because your monthly payment capacity has not changed. A buyer who qualified for £300,000 at 2% might only qualify for £220,000 at 5%. Their purchasing power did not just become more expensive, it shrank by over 25% in real terms. Multiply this effect across millions of potential buyers, and you begin to understand why the market seized up so quickly. The speed of the rate rises meant that buyers had no time to adjust psychologically or financially. In a normal tightening cycle, rates might rise by a quarter point every few months, giving households time to recalibrate expectations and rebuild savings. This cycle compressed what would normally take 5 or 6 years into less than 2 years. Buyers who started their property search in January 2022 with a mortgage agreement in principle found that agreement worthless by June. Their approved borrowing amount no longer covered the properties they had been viewing. Some discovered mid-chain that their mortgage offer had been withdrawn because rates had moved again and they no longer qualified. The goalposts were not just moving, they were sprinting away from buyers faster than anyone could keep up. Then came the mini budget shock. In September 2022, the short-lived Truss government announced a package of unfunded tax cuts that sent financial markets into chaos. The pound collapsed. Government bond yields spiked to levels not seen in decades. Pension funds faced margin calls. And crucially for the housing market, mortgage lenders completely withdrew from the market. Within days of the mini-budget announcement, over 1,700 mortgage products were pulled from sale. Lenders simply could not price risk in an environment of such extreme volatility. Buyers who had been days away from completion found their mortgages cancelled with no alternative products available. The market did not slow down. It stopped entirely. For several weeks, there was essentially no functioning mortgage market in the UK. Even after stability returned and products came back, they returned at much higher rates than before. The mini budget did not cause the affordability crisis, but it accelerated it dramatically and shattered whatever remaining confidence buyers had. The psychological impact of these shocks compounded their financial impact. Markets run on confidence as much as on fundamentals. When buyers believe prices will rise, they stretch to buy quickly. When they believe prices might fall, they wait hoping for better deals. The combination of collapsing affordability and extreme volatility flipped buyer psychology completely. The fear of missing out that had driven the frenzy was replaced by fear of buying at the peak. Suddenly waiting felt like the smart strategy. Every month that passed seemed to confirm this view, as asking prices softened and properties lingered, unsold. The herd mentality that had created bidding wars now created a buyer's strike. Nobody wanted to be the one who bought just before prices fell further. This psychological shift happened remarkably quickly. Survey data shows buyer sentiment collapsing over just 2 or 3 months in late 2022. The speed of the mental reversal matched the speed of the financial shock. The chain dynamics of the UK property market amplified the pullback effect. Unlike many countries where buyers typically sell and buy independently, the UK market operates largely through chains. A first-time buyer purchases from someone who purchases from someone else, who purchases from yet another seller. When one link breaks, the entire chain collapses. In a confident market, chains complete because everyone pushes forward, knowing delays risk losing their purchase. In a fearful market, chains collapse because any participant can decide to wait. The autumn of 2022 saw chain collapse rates spike to levels associated with major financial crises. Estate agents reported that 7 or 8 out of 10 agreed sales were falling through. Each collapse created cascading disappointment. Buyers who had spent months searching and thousands on surveys found themselves back at square one. Many simply gave up and decided to wait until the market stabilised. Their withdrawal removed still more demand, creating a self-reinforcing cycle of retreat. First-time buyers were hit particularly hard by the speed of the pullback. This cohort had been stretching to maximum affordability even before rates rose. Many were already borrowing 5 times income or more. When rates increased, their carefully constructed affordability calculations fell apart instantly. A couple who had saved £50,000 toward a deposit and qualified for a £250,000 mortgage suddenly found they only qualified for £190,000. Their total budget dropped from £300,000 to £240,000 overnight. In most UK markets, that difference moves you from a 2-bedroom flat to nothing at all. The properties they could now afford did not exist in the areas they wanted to live. Rather than compromise dramatically on location or size, many simply stopped looking. First-time buyer mortgage approvals fell even faster than the overall market, reflecting this particular squeeze on stretched affordability. Existing homeowners looking to move up the ladder also retreated rapidly. The maths of moving had changed fundamentally. Previously, they might have been trading a £200,000 mortgage at 2% for a £300,000 mortgage at the same rate. The payment increase was manageable. Now they faced trading that old cheap mortgage for a new expensive one. Many homeowners realised they were better off staying put on their existing low fixed rate than moving and taking on new debt at double or triple the interest rate. This lock-in effect removed a huge chunk of potential buyers from the market. Properties at the mid to upper end of local markets suffered most as their natural buyers decided moving made no financial sense. The housing ladder that had functioned for generations suddenly had broken rungs that nobody could afford to climb. Buy-to-let investors retreated even faster than residential buyers. The investment case for rental property had been deteriorating for years due to tax changes and increased regulation. Rising interest rates destroyed what remained of the financial logic. A landlord buying a property with a 75% mortgage at 2% could achieve positive cash flow relatively easily. The same property with a 5 or 6% mortgage would generate negative cash flow. Every month, the landlord would need to subsidise the property from other income. For leveraged investors, this made no sense at all. Buy-to-let mortgage applications collapsed by over 60% from peak levels. Many existing landlords decided to sell rather than remortgage onto punishing new rates. This removed significant buyer demand from the market while simultaneously adding supply as investment properties were listed for sale. The regional pattern of the pullback reveals important dynamics. London and the South East experienced the sharpest buyer retreat in percentage terms. These markets had seen the most extreme price growth during the boom and now face the most extreme affordability constraints. Average prices in many London boroughs required household incomes that simply did not exist at higher interest rates. International buyers, who had supported prime London markets, also retreated as the strong dollar made UK property less attractive, and global economic uncertainty increased. Northern markets proved more resilient initially. Lower absolute prices meant affordability constraints bit less hard, even as rates rose. A buyer who qualified for £150,000 could still purchase a decent property in many northern towns, even if they had qualified for £200,000 before. But even these markets eventually felt the chill as confidence collapsed nationwide and economic uncertainty spread. The new build market experienced its own version of the buyer pullback. Developers had been selling properties off-plan at prices that assumed continued price growth and continued cheap mortgages. Buyers who had exchanged contracts in early 2022 faced completing in late 2022 or 2023 at much higher mortgage rates. Some simply could not complete because they no longer qualified for the mortgages they needed. Others used break clauses or walked away from deposits rather than complete on purchases that no longer made financial sense. Developers faced rising construction costs at exactly the moment demand collapsed. Many responded by slowing or stopping new projects. Housing starts fell dramatically, adding to long-term supply problems, even as short-term demand vanished. What lessons can we draw from the speed of this buyer pullback? First, markets can turn far faster than anyone expects. The transition from boom to bust took months, not years. Anyone who delayed a decision expecting gradual change was caught off guard. Second, compound shocks create non-linear effects. Rising rates alone would have slowed the market. Rising rates plus the budget chaos plus collapsing confidence created a near-complete market freeze. Third, the UK property market is particularly vulnerable to rapid rate changes because of high leverage levels and chain dependencies. Unlike markets where buyers commonly put down 30 or 40% deposits, UK buyers are stretched thin, and any affordability shock has immediate impact. Fourth, psychological shifts can be as powerful as financial ones. Once buyer sentiment turned, the retreat fed on itself as waiting became the consensus strategy. For those watching this market now, the question is, what happens next? The buyer pullback has been sustained now for nearly 2 years. Transaction volumes remain well below normal levels. Mortgage approvals have stabilised but at historically low numbers. The buyers who retreated have not returned in significant numbers. Some are waiting for prices to fall further. Some are waiting for rates to drop. Some have simply given up on buying and found other solutions. The market is in a strange equilibrium where limited supply meets limited demand and not much happens. Prices have fallen in real terms, but nominal prices have proven stickier than many expected, partly because sellers are also reluctant to accept the new reality. For potential buyers watching this analysis, my honest assessment is that the conditions which caused the pullback have not fully reversed. Rates remain elevated compared to the era of cheap money. Affordability remains stretched by historical standards. The factors that made buyers retreat are still present, even if the most acute crisis has passed. However, waiting forever is not a strategy. Life continues. Families need homes. At some point, the right property at the right price in the right location justifies action regardless of broader market conditions. The key is to stress test any purchase against scenarios where rates stay high or rise further. Assume the market might fall another 10 or 15%. If the purchase still makes sense for your life circumstances, then it may be right for you. If it only works in a best-case scenario of falling rates and rising prices, then you are taking risks you may not fully appreciate. For sellers, the buyer pullback means accepting that the market has fundamentally changed. Pricing strategies that worked in 2021 are counterproductive now. Properties priced correctly for current conditions will sell. Properties priced for a market that no longer exists will sit indefinitely while you pay carrying costs and watch comparable properties sell below you. The buyers who remain are serious and often well qualified, but they have options and they have patience. They will not overpay simply because you need a certain number. The sooner sellers internalize this reality, the sooner they can make rational decisions about whether selling makes sense and at what price. For anyone trying to understand where the UK property market goes from here, remember that the speed of the pullback was unusual, but the destination was not entirely unpredictable. A market built on cheap money was always vulnerable to expensive money. A generation of buyers who had never experienced rate rises was always going to struggle when rises came. What surprised everyone was the pace, not the direction. The return to normality, if it comes, will probably also be slower than anyone expects. Markets heal gradually. Confidence rebuilds slowly. The scars of the pullback will influence buyer and seller behaviour for years to come. Thank you for watching UK Property Info. If this analysis helped you understand what happened to the UK property market, please share it with others trying to make sense of these strange times.